Business owners. On July 4th, 2025, Congress put into play or passed a bill, which was later signed off by the president, titled the One Big Beautiful Bill, which was tax reform. But what that really was close to 1,000 pages worth of bill that fundamentally changed the way we perceive taxes or retirement planning or compliance. So, regardless of what side of the aisle you sit on, whether it's left or right, I think everybody could agree that's a pretty big bill. So, the attempt of this video, or what I want to accomplish in this video, is with the help of my business resource team, identify 10 of those opportunities that are in that bill that can help business owners, specifically business owners in partnerships or corporations outside of C corporations, take advantage of this tax reform on their own personal taxes and business taxes, and also identify some things that could be challenges. So I'll start with the first advantage. The first advantage was the fact that we kept our income tax rates right where they are. So this was extremely popular on both sides of the aisle to keep income tax levels where they are because people in general don't like it when you raise their taxes. So we're at historical low income tax rates. The highest tax bracket is 37% on the federal level. And that's only for a joint couple or married couple filing jointly at $752,000 of reporting or higher. That's a very small percentage of the population. Most of us are within the 10% to 35% tax bracket, which again are historic lows. So that was a good thing that came out of this bill. The second piece or opportunity that came from this bill was the fact that our standard deductions remain at all-time highs. So if you're filing a return and you're not being claimed as a dependent, you're able to write in a $15,000 standard deduction per person. What that also expanded to is the fact that now children, minors that are filing a return, when they file a return and don't be claimed as a dependent, that they're able to now take advantage of the $15,000 deduction. Most business owners that have children know that having children as dependents isn't really that much of a deduction. So if you're able to employ them within your organization and pay them a wage and have them file their own return, now they're able to take up to a $15,000 standard deduction. That leads me to my next opportunity, which is income shifting. So what I mentioned just there in my last piece about using the standard deduction would be paying your children's salaries, or maybe you have a dependent adult or aging parent that you would, instead of claiming them as a dependent, shift them and put them on the payroll and have them file their own returns. This would automatically trigger the $15,000 standard deduction. There's other ways we can use income shifting strategies that we can get into, and it goes way down the line, and get really into the weeds with it. But basically, what this bill is enabling us to do now is use a lot of those income shifting strategies to our advantage as business owners. Which leads to my next opportunity, the accelerated depreciation. All right, so what this law or this bill put into place or reinstated was a bonus depreciation. And it raised the limits of that depreciation on what you're actually able to depreciate or write off. So prior to this bill, the limitations were up to $1 million, and there was a phase out stage up to 2.5 million. That limit went from 1 million to 2.5 million, goes up to 4. So if your business is making capital improvements to your business and you want to write off those improvements, or you have depreciating assets, you can write off exempt up to 2.5 million, and there's a phase out stage up to $4 million of that capital investment. Which leads to my next opportunity, which is research and development expenditures, or R&D expenditures. So what this bill effectively did was put together basically like a double benefit that businesses that use research and development in their practice can use to their advantage, which one includes having a 7 to 12% credit applied for their research and development expenditures, but also there's now a look back period of the previous 3 years of filing, which are years 2022, 2023, 2024, and see if there's a recapture that could be done for any R&D expenditures that weren't applied or weren't credited in the past. So if this is the type of business that you run and you have R&D expenditures, I would encourage you to get with your professional and see if there's a credit that can be applied, meaning recapture of money that you've already paid the IRS and put right back into your pocket. Which leads me to my next opportunity, which is retirement plans or employee benefit enhancements. So the IRS created credits that businesses can take advantage of if they're putting a 401k plan or retirement plan in place moving forward, or startup plans. Also, what it did was expand how much you could put in as business owners and employees alike towards your retirement plans. What it also did was created opportunities to install defined benefit plans or cash balance plans, opportunities that employers or business owners could not otherwise have taken advantage of. So, if you've had a 401k or some sort of retirement plan in place that you haven't taken a second look at, maybe look at it again to see if there's ways you could enhance or expand what you could personally do as a business owner, but also give off to your employees to help retain them or to just enhance their overall experience as your employee. The next advantage that this bill expanded on was the qualified business income deduction. What this bill did was make that qualified business income deduction permanent. Also, and this is something that you as business owners should know, the actual way business owners can take advantage of the qualified business income or QBI has expanded its terms. So, what it is right now is the qualified business income deduction is a deduction of 20% of your net income to the business. So, when you're filing your returns, the way you're going to apply that deduction is either 20% of the net income to your business or 20% of your personal earnings, whichever is less. So, this being permanent is a good thing, but also this is where it's going to take some work as a business owner working with your team to see if you can maximize deductions. I mentioned earlier in the video about income shifting. Well, think of it this way. If your net income to the business is here at a high number, and you're still trying to get as much write-off as possible, but you're paying yourself a very low salary, which is what a lot of business owners do, again, that deduction is going to be 20% of whichever is less. So you may want to pay yourself more, take less out of the net income from the business to try to raise that level of what you're actually writing off on your returns. The next opportunity I want to talk about is the incentives this bill has made for family-owned businesses when it comes to taking advantage of tax and gift exclusions for estate tax purposes, which this bill made permanent under this new law. So, moving forward in 2026, the exemption that you can use for estate taxes or the estate tax exemption and gift tax exemption is 15 million per person. So per couple, that's 30 million worth of exclusion. One of the things that this bill, or before this bill, piece of the code for taxes exclusion that was under fire was the estate tax exemption. They're talking about lowering it. Well, this law put that in place permanently. And currently in 2026, this had increased from last year from 13.99 million to 15 million per person. So it's highly encouraged now moving forward that you get with your team, look to see what you can do with either estate planning through your CPA or estate planning attorney or financial professional to take advantage of these exclusions, which seem to be permanent. Permanent is a relative term when it comes to law, by the way, if you haven't figured out already or already know. Permanent isn't always permanent. Permanent is until Congress tells you it's not. But for all intents and purposes, this bill had made this exclusion permanent. The next opportunity I want to talk about is a qualified small business stock exemption, or QSBS. So, how it currently stands is if there's a sale of your business in the form of shares or stock to another entity and you receive money for that, there would be a capital gains tax on your profit. Well, if it's done in the form of shares, there's an exemption. That exemption had gone from 10 million to 15 million for long-term capital gains if you've had the business over 5 years. And under 5 years, there's a 50 to 75% phase out for the gains that you would have to pay. But the fact of the matter is that exemption had raised again from 10 to 15 million. But this only applies for not all pass-through entities, just the ones that have shares in the sale. So what that means to you as a business owner is most businesses are pass-through entities, unless you're a C corp or what have you. But S corps, partnerships, sole proprietorships, like they're all pass-through entities. When you sell your business, if you're in a position to sell your business and you receive compensation for that, you would have to pay basically taxes on the money that you're receiving in the form of capital gains tax. However, if you're incorporated and you have shares on your company and there's a value to that share, there's a basis, meaning a value which you initially put on that share. Whatever you've made off that is now your gain and is exempt from up to $15 million. So if you're in a position with your business to sell in the next 5 years or so, or even something where you can see the tangible future, it's encouraged that you look into it a little deeper into restructuring or changing the way your business is incorporated so you can start taking advantage of this exemption. Not paying $15 million on capital gains tax is a pretty big hit. All right, it's pretty nice. Something I want to take advantage of. Which leads to my next opportunity, which is complimentary reviews from me or my team to see if there's any ways you can take advantage of these exemptions or deductions or credits. So what it really comes down to is business owners in general pay high taxes or pay a lot in taxes. What I'm really concerned about is not so much the dollar value, even though that is important. What I'm more concerned about is the effective tax rate. So, as a business owner, if your effective tax rate is over 20%, anything over 20%, you're more than likely leaving some money on the table. So, what I can do, what other professionals can do, is start looking through how you're incorporated, what exemptions you're taking advantage of. There's income shifting that can be done to see if you could lower that effective tax rate and put more money back in your pocket. So, I mentioned this bill had a couple challenges involved as well. Well, I'm going to talk about a couple of those challenges, or two of those challenges anyway, which first one being the loss of personal exemptions or miscellaneous deductions. So, like CPA fees or tax prep fees or financial advisor fees, that's one example of something that's not going to be deductible anymore. Also, unreimbursable employee expenses that you might have had that you were writing off or not having to categorize in the business category under the business are now going to have to be categorized in the business or under the business. Where prior to this bill being passed, we could, the line was kind of gray. We could put it as a personal or put it on your personal returns as a deduction, whatever that might have been, whether it was meals and entertainment or what have you. It really didn't make a whole heck of a lot of difference. Now it does. So, from a compliance standpoint, when I say compliance, IRS, compliance standpoint, anything that you have that would be a reimbursable deduction will have to be categorized through your business. Also, on top of that, is the compliance complexity. So, I went through this video a lot of different ways to take advantage of this big, beautiful bill, the tax reform, and use it to your advantage to either income shift or just get credits or deductions and so on and so forth. But it has to be done in a manner that doesn't raise red flags. So, the IRS is going to scrutinize what is being done. Meaning, if you're a DIYer that puts your own retirement plan in place or starts, putting together, payroll where you're paying your kids now for certain things that they're doing through work, what I'm telling you is you're raising the risk level on your end. You'd want to have, let's say, for example, if you're going to employ your children and pay them a salary and have them file their own returns and take a standard deduction, make sure with your accountant and your team that the job they're doing makes sense on paper. Okay. So, some of the key takeaways from this entire video. One, first, that if you are, as a business owner, paying an effective tax rate over 20%, you may be laying some stuff on the table. Okay. So, get with your team, have somebody take a second look at what you're doing and see if there aren't advantages that you could take advantage of. Also, on top of that, there's look back that can be done. So you could amend what you've already paid or what you've already filed on your taxes and get recapture money. Check into all those advantages. I mentioned the R&D expenditure. Well, that's being put into place where there's a look back period. What we've come to find out was that some businesses and business owners that we deal with that don't think they even fall in that category actually do. So work with your team. There might be some things, again, that you're laying on the table that you might not even been aware of. So that all being said, I hope for a healthy 2026 and beyond. If there's any ways I can help, like and subscribe.